Hello everyone, my name is Francis Sabourin from Richardson Wealth here in Montreal with Aram Gafari Aram. Welcome to our 2024 review and 2025 outlook. Happy New Year, by the way. And Hassan, what a great year it was 2024 for the economy, the stock market, for everyone.
Good morning and happy new year, everyone. Happy to be here. I wish you the best for you and your family. Amazing. 2024 was a surprisingly uncertain year, but everything that we got was in an upside surprise, and that was really translated in the return of the market. As you see in the slide, the first slide that we had, S&P 500 closed at 25% up. Japanese was 20% up. Asian market, except Japan, was 12%. Every single market that you see was positive. And the main reason of that, the main driver of that is the healthy consumer, especially in the North America and the developed market. So in the US market, we had this inflation, although the economy was very resistant. Also, we have AI, artificial intelligence enthusiasm. You see it from the NVIDIA, you see it from the many software companies. And also we have the expectation of lower tax and regulation aftermath of the US election, which has not been materialized, but the market is banking on that now. And also the Japanese market, the reason that we put Japan here because it was the second winner of the 2024, and we invested in Japan. Our Japan sleeves in our portfolio was up 19% for the year in Canadian dollar. So it was a very good contributor to the result. What happened in Japan is after 15 years, the corporation in Japan decided to be more in line with the investors and buying back the stocks and more sense of the M&A. So that was a very important change in Japanese market. Also, we are seeing an inflation after 20 years, signals inflation, so the market and consumer like it. And also, as that was the main reason for us, the third concept that if there is any kind of the real trade war in the world, Japan going to be one of the main beneficiary of that. Developed countries next to the China, an ally of the United States. So Japan can play both sides of the aisle in the trade war.
But in 2024, saying emerging markets had a rough time. They were negative or quite smaller performance, but our play with India, which is considered as an emerging market, they did very well.
So when we're talking about the emerging markets, yes, they are now having headwind. And their main reason is if the President-elect Trump comes to the office, if the yields goes up, if the dollar appreciate or stay at the same level, what's going to happen to the emerging market? That's always a tough time. However, Indian game is a little bit different here. So China was a game poster for the last 10 years. Now we see the difference in demography, consumption, and also lack of strategic decision from the policymakers. This is not happening in India, and the India is now benefiting from that. However, in the last months, we have seen a little headwind in the India too, but in the long and midterm, we do believe in India because of the consumption and because of the change that we are seeing from China all the way to the India.
And in terms of sector breakdown, it's pretty amazing how the growth came, where the growth came in 2024, and I will let you cover it.
So 2024, as we said, is AI enthusiasm and also consumption from the consumers. So we have TSX and S&P 500, the Canadian version of the stock market, and the US index. So let's start from the US. As you see, the tech plus consumer communication services are 40% and 35% up. You have Google, you have Tesla, you have NVIDIA, you have all this kind of stuff in these two. And also the big six, magnificent six that we're talking about was the main driver of the EPS growth in the United States of America. Also financial benefited a lot, 28%, let's say 29% for 2024. Financials going to be the winner in 2025 too, because we do believe that there are four factors which define these sectors. We invested in these sectors, and we're going to go in detail more. The first and most important thing is now we are seeing the yield curve is steepening. So that's good for the banks, big banks, which lend out money, like Bank of America, which is more to the mortgage side of the business. We're also seeing more M&A. When Monsieur Trump is in the power, so is more business oriented. So you're going to see more acquisition. Big companies buy small companies, or two big companies merge together to have the more market share. So this is the M&A, merger and acquisition. Who make profit out of merger M&A, merger and acquisition? The big banks. Goldman Sachs is the main beneficiary of that. You have Goldman Sachs in your portfolio, and also you have transaction between the companies when they trade all of these things, treasury of the companies. So which benefit from that? Citibanks, the international part of the banking system in U.S. Economy. So you have Citibank in your banks, in your financial sector too, in our portfolios. We think M&A, steepening yield curve, and more economic growth, which bring more demand for loan, will be the drivers of the financial sectors. And it was the same for 2024. It's going to be the same for 2025. Also, industrial going to benefit from the change that we are seeing. You're hearing about onshoring the manufacturing, made in America, made in Canada maybe soon. So all these means more factories, more capital expenditure, so more need for industrial products. That's the main reason. However, you've got to be careful in selection, which kind of the industry companies you want to select. So it's not about just buying the ETF of industrial sectors, because there's so different things in that. Is your company international, or is it an American-made company? That's a big difference here. So industrial selective companies in industrial sector will benefit the most from new legislation and new administration in the White House. Also in the industrial, we are waiting for a new continuation of the new Mr. Trump idea of capex, like depreciation, 100% of the capex if the company puts more investment in the United States. That will be a booster for the cash flow, from the cash flow for the companies, and that's very important. And the last but not least, consumer discretionaries. If you see consumer discretionaries in the United States up 30%, the main reason of that part is Tesla. So you have one of the main reason of consumer discretionary is the Tesla. However, you've got to be careful when you're talking about consumer discretionary. You are talking about one of the most sensitive part of the consumption in the United States to the interest rate level. So if we're going to talk about the interest rate outlook of our team. If we are in the time that inflation going to stay at this level, which is not crazy high, but more than the norm, and interest rates going to be a little higher or stay at a high level for the quite time, so maybe consumer discretionary, you have to think about that. I'm not saying that consumer discretionary is forbidden. No, it's good to have consumer discretionary, but you have to be very selective. You have to be very selective which company and which sector you are, which exposure of the consumer discretionary you are buying.
But overall, the price change and the P/E ratios and the EPS has been very impressive for some stocks, not some sectors. So we'll let you go through.
Very, very good point. So if you open CNBC or I don't know Fox News market analysis or or CNN market analysis, they're talking about the valuation is so high, it's very expensive. True. In absolute term. What about the relative valuation metrics? So in the table below, at the bottom of the slide, you see that we have the 6 big tech companies like Google, Alphabet, Amazon, Tesla, Nvidia. You have those 6 companies. So the price of these companies in the course of 2024 has been increased 47%. It's huge. It's huge. Versus the rest of the market only 14%. Yes. Is it risky? Let's go in detail. So the P/E ratio, which gives you how much you are paying to get $1 of the profit. The higher it is, you are paying more for $1 of the profit because you think it's going to be better in the future. So the P/E, this ratio, the P/E for the big 6 increased 6%, but for the rest of the market, it's increased 8.6%. Oh, so that 47% increase in the price have some rationality behind that. And then the EPS, the absolute dollar value that these companies made, increased roughly 40%. That's the last comment, the EPS. 40% versus the only 5% for the market. So what I'm trying to say is that, yes, the price has been increased, but not because of the bubble. because of the increase in the earning growth of the companies.
Yeah. So that's why these stocks did really well last year, and most of them we own it already, and we have been owning it since a few years ago, maybe almost 10 years. So it's not as yesterday that we own Apple, Google, Meta, Microsoft, and so on.
You remember the Meta has a rough time of 18 months ago? We spent about an hour discussing about that, and we decided we keep it because Meta has the largest data of AI usage, software, and consumer in all these companies.
Yeah, good. And on this slide, we talk about reality check, expectation versus actual outcomes. Exactly. You know, the GDP, the forecast for the GDP in 2024 at the beginning of the year was like 1.25, and now we end up, if things keeps going, 2.7 for the year. That's a huge upgrade now.
The stock market plays about the expectation. It's all about where we're standing now and what's our outlook for the future. So 2024 was uncertain, but whatever we got was in a positive surplus side of the game. So yes, as you see, the consensus forecast for GDP started with 1.3, ended at the time that ended around 2.7, and as I check it for the this morning, we're gonna close Q3 revision with 3.1%, even better than 2.7%. Where does that come from? U.S. consumer are spending. The U.S. consumer are spending at 3.7% annual increase, and we haven't had the data for the December Boxing Day things yet. Okay, so U.S. consumer are healthy and they're spending. The next one is consensus of the probability. Look, when we started, it was about 50% to 40% probability of recession for 2024. We ended with just now at 20%. So it's very important to think about outlook and the expectations.
And what about the interest rates cut we were expecting this year?
So we started with 7 cuts expectation. And now we are saying about all during the cycle for the next 2 years, we're going to have about 5. That's going to be 5. It's going to be about the 5 cuts. So what's happening is this. When we start 2024, we were like, okay, you know what? The interest rate is high. The economy is going to suffer. The Federal Reserve is going to cut. But as we showed in the previous slide, the economy showed resistance. So although we are seeing increase in the interest rate, I'm talking about the second graph in this slide, the upper line, the blue line, although you are seeing the increase in the interest rate, but the stock market is doing well and the economy is doing well. So what is the source of increase in interest rate? Is it inflation or is it something else? It is inflation expectation, but it's mostly about the economic growth of United States. So we are seeing that the people are saying, oh, the economy is growing at 3.7%, so we need higher interest rate to be at a neutral position. That's what's really happening. And to prove that, look at the gray line here that you have. This is the spread that the high yield corporations have to pay on top of the US government interest rate. If I am a corporation, I want to raise money, I'm more risky than United States government, so I have to pay more to the investors to persuade them to lend me money. That line is that spread, the difference. So look, after August 2024, the interest rate has been increased, but that spread is going down. So when the spread going down, it tells you that the companies can raise money easily from the market. In which environment that's happening? In a good economic environment. So all in all, if I want to say, historically, especially from 1980 to 2004, when the interest rate changed, it was the reaction to the inflation. However, now we are seeing a little of the inflation and more about the expectation about the economy.
Good. And what about inflation, either in Canada or in the US? It has been slowing down as we were expecting. Yeah.
So every quarter we have this chart because it's very important for us, for everyone, from your day-to-day life and for your portfolios. So yes, the right is the Canada, the left is United States. As you see, the trend is downward. But in the US, you see a plateau on the orange line, which is the core inflation. So the core inflation is at a plateau, so you cannot bring it down more easily at the moment. And why? Because of that high economic growth that we are seeing. However, in Canada, the right side of the table, as you see, we are seeing inflation going down. So the core inflation is going down because our economy is different from the United States. We're going to talk about that later. I want to emphasize on the chart, on the graph below. So there's three lines, the green, the orange, and the blue. As a stock market, you should pay attention to the blue one. The blue one is the financial condition. It's a combination of three metrics. It's a combination of the money market, equity market, and bond market. And every week it gets updated. So when it is below the line, when it's on the negative side, it means that financial condition is not tight, it's loose. It's good for the companies and the economic activity. When it's above the zero, it's tight. It means that credit is not available. So again, I want to emphasize in this that the 10 years goes up, the orange line is going up, but as you see, the financial condition is going down, negative, negative. So the economy is good, the market goes up.
So, but in the States, we talk about the neutral rate of interest rates, or the R star. So it's much higher than expected. And thanks to productivity, as you mentioned, and this is very interesting, that was the story of 2024 at the end.
Yeah. That was the story of 2024. What's happening that every part of the world is lagging, but United States is on all turbocharge? What is really happening? Let's go to 2025, starting 2015. Starting in 2015, the US economy showed increase in productivities. So productivity, what's the productivity? Productivity is how much output do you produce for 1 hour of work. The higher, the better. So that's a simple way of saying the productivity. We just put it here between Canada and United States. The orange is United States and the blue line is Canada. As you see, the gap is widening. And that's the main reason that inflation is higher in the United States, economy is growing faster, and you see this huge increase in the stock market, because at the end of the day, the productivity is the main driver of the economic growth and profit of the companies. So unemployment rate in US is 4.2%, in Canada is 6.8%. Participation rate, pretty much the same. Wage growth is 4%, 3.9% here. GDP growth, so it was 2.7, now just updated to 3.1%. In Canada, we are talking about 1%. So that's a huge difference. So if I put it in the context, the productivity, the average productivity increase in the United States is 2% per year. In Europe is 1%, and in Canada, unfortunately, it's flat. What should we do? Why is this happening? Just to pick in a nutshell, the US has the highest R&D, research and development, R&D investment in all developed countries. That's the main reason. The second thing is the regulation is much easier in the United States, especially in the labor side. And also, it's a technology-driven economy.
Good. And what about, our assumptions for 2025? Because the past is the past and the future needs to be understood.
So we do believe the US economy will continue to perform well. And that's because the US consumer are showing resistance. The chart, the chart on the left show you the US consumption. So the consumption and disposable income. The disposable income is the orange line, is higher than the consumption, and the gap has not narrowed. So boom, you're gonna continue in the same path. And that's the same for Canada too. So as you see, the disposable income going up, the household final consumption is in the same pattern. It's very surprisingly good. The Canadian consumer for Q3 showed resistance thanks to the lower interest costs that they pay. So the consumption in Canada increased 3.7% for the Q3, and the saving rate was at 7.1%, the highest in the past 7 quarters. the difference between the disposable income versus the consumption was the highest in the past 6 months. So what is happening? Because of the cuts in interest rate from the BOC, you see a little of the relief for Canadian consumer, which shows us the best since 2021. So that's the main reason, and you can see it in the bottom chart at the right. You see the orange line is up and the blue line is down. That's because of the less interest cost that they have to have. So US economy and consumer of US economy, we think that the bond yield going to go a little higher. We are expecting to the bond yield kiss the 5% for 10 years in the US. You are seeing it in UK. We are seeing it in Germany at the moment. The increase, the meaningful increase. So we're going to expect that in US too. That's not going to derail the economy of the United States, but you're going to see a bumpy road in the stock market. And we are cautious about the commodity prices. The US dollar is strong. We expect to be strong because of the strong economy. Global trade is a little at the limbo stage. We don't really know what's going to happen. Nobody really knows what's going to happen based on the new administration in the United States. And the stimulus out of China was not good enough in the last year. So commodity is a cautious play.
Good. And our investment themes for 2025, I mean,
what we are going to do.
Yeah.
So we put it here in the context of brief and big picture. We're going to long US versus the rest of the world. If you give me $1, you say you have one shot, it's still United States of America. Why? Because it has the lowest operational leverage in major economy. What does it mean? It means that based on the profit, when they want to make the profit, they have the lowest fixed cost and variable cost to generate $1 of the revenue. And that is mainly because of the technology, productivity we talk about, and also very, very loose labor regulation versus the rest of the world. Also, the US will benefit from the Mr. Trump second term, the economy, I mean. And the US people has the highest wealth effect among the others. If you're talking about the quality versus the value, we are in the quality camp at the moment because in the first Trump presidency, quality outperformed the value, and also quality usually like 90% outperform value when the volatility goes higher. So you want to be a quality. And if you're talking about the Europe versus emerging market as a whole, as a ETF of emerging market. So we prefer Europe because the strong dollar is going to be headwind for the emerging markets. This is important. And also they have more exposure to the commodity, 11% versus the 9%. And when Trump is speaking about trade tariff, he's going to push it on China, Mexico, Korea, and Taiwan. So we want to be a little more cautious about that.
Not India,
yes, because there's so many political reasons for that. But so far, we think India is safe.
Good. And what are we watching daily or for our?
Nobody has crystal balls, so we have to be careful. And what we are watching, there's some risk to this environment that we talk about. The valuation is high on the absolute value, on the absolute metric. On the relative we talk about, but on the absolute, yes, it's a high. So it means the expectation is a little stretch. So we got to be careful about that. So nobody knows exactly what's going to happen after all these Mr. Trump policies implemented. So it's like you go to the doctor, they give you 4 different pills, you know it one by one, but you don't know what's going to happen if you take all of them, the combination. So that's the stage that we are. We don't know the combination of cutting tax, reducing immigration, and deregulation. So we don't know what's going to happen to these things. Bond vigilance in the United States. They are back again in the UK. If you see the bond on the gilt, you'll see it. We have to see. We have to see what's going to happen in the US. And the market is so optimism. So look at the graph. This is the percentage of the investors that expect the market going to be higher in 2025.
So stay invested.
Stay invested, be careful, and enjoy the ride.
Yeah. So to make a summary of our performance for 2024 has been a great year. As we mentioned, this is our gross performance. 2024 has been our 16 years as discretionary portfolio manager. If we want to hold sleeve you send us, we have but today we want to focus on the last 2 years. And the income, for example, 18.7 gross performance. Income and growth, our balanced portfolio, 22%, our long-term growth, 25%, our dynamic growth, 27%, and our global equity in Canadian dollars, almost 24%, not dollars, sorry. And for the last 2 years, it has been like pretty amazing. The cumulative performance for our income is 35% compared to our benchmark at 19%. Our income and growth, 42.5% compared to 27% for our benchmark. Long-term growth, almost 50% compared to 35%, and our dynamic growth 54% compared to 40%. Our global equity is a little bit behind our benchmark. It's per nature because our global equity has an emerging market tilt in it. It's not the pure DM or developed market. Yeah, so that's why I've been lagging a little bit, but we don't. It's no big deal for us. And just remember in 2022. Lastly, when we did the exact performance review, 2022 we were down, in 2023 we were positive, as you saw, but on both years we were positive, which is what's pretty rare for a lot of managers for all our mandates. So we are very proud. We work very hard, and also in 2024 something has been very special. We didn't do any sells or buys. We kept the same holdings for the whole year. We should expect some rotation this year. But that has been done with zero rotation. So tax-wise, we have been very amazing. It's for us this year has been a 10 on 10. So thank you for your time, your patience, your trust, and feel free to reach out either to me, Hassan, Jean-Marc, Michael, Stéphane, or Christopher to get this presentation that will be also available in French, or a scorecard, or whatever you want to discuss about it. So we want to thank you again, and we have to stay humble. We never know what 2025 will be, but we expect to do the best for you guys. So thank you.
Thank you so much. Have a good year.